we have a situation where the price trajectory is so clearly bullish and so clearly going up that the entire industry knows it.
All right, everybody, I have a massive interview to drop right on your head. I know you've been following me for some time and you've been listening to me just go on about uranium like crazy. And I thought, who better than the original Uranium Insider, Justin Huhn, to come over here and tell you exactly what the thesis is, but also to tell you exactly what's going on right now in the thesis, because every single week, there's something new and usually something really positive happening in the world of uranium investing. And it is my pleasure to introduce to you, Uranium Insiders, Justin Huhn. Welcome to the show.
How are you doing, Fabi? Thank you for having me.
I am doing really well. Justin, you have what I probably consider the first uranium-based or uranium-focused newsletter. So you're in the trenches every single day. You have a very strong network of contacts in the industry, which I think for this particular industry is probably the most important thing in order, to assess where you think the market's going and, the ups and the lows of the market. And you have a lot of experience, looking at all the different numbers, looking at the demand and supply story. So tell me, what is the story, I guess, with uranium? Why is it still attractive? We've been hearing about uranium a lot. The price keeps climbing and climbing. I'm not going to say a number because by the time that we put this out, I'm probably going to be a little bit late and people are going to come right to me and say, hey, it's up $5, it's up $10. But it's doing very well finally after, a good couple of years of not going anywhere. Why is uranium still interesting and what's the thesis?
That's a good question. I think that the core thesis has essentially gone unchanged for years, in my personal opinion. And that's the type of thesis that you really want to make around any sort of commodity-based investment. It really is just kind of what are the supply and demand fundamentals. That's the core, and that's important to understand still. And it, of course, was very important to understand when it was a hated commodity, a hated sector, very much a contrarian investment. We're talking, 5-6 years ago. The commodity bottomed in late 2016, and back then, the only thesis really was a contrarian bet that it would turn around and the commodity would rise in price eventually at some point somehow. So that was basically a study of how much above ground mobile inventory was there roughly. This is a very difficult number to wrap your head around usually, but because it's such an opaque market and so difficult to get certain elements of information. But it was an understanding of inventory, commercial inventories, above ground mobile inventories, and then looking at the actual structural demand from reactor operations, the uranium burnup per year compared to the supply, and looking at that and trying to project that out into the future, coming to a conclusion that supply was in shortfall or would be in shortfall. 2016 was prior to McArthur River going into care and maintenance, which was a major catalyst for reducing production to 18 million pounds a year and therefore turning that producer into a buyer. So that went a long way towards consuming a lot of material. But, the core thesis really was and is based around how much supply is coming into the market and how much demand is there. And that sort of situation has been exacerbated since 2017. So we've consumed a lot of above ground mobile inventory. This was not only the producers like Cameco, but also the Sprott Physical Uranium Trust, and then just the industry under contracting and buying, above ground mobile inventory via carry trades and from the spot market. And that lasted for years as the commodity started to recover. Now we're in this situation where we've got a 30 to 50 million pound supply deficit for this year alone. I know that's a big swing between 30 and 50. That depends a lot on how much inventory restocking purchasing is being done by utilities. how much secondary demand there is. And we're almost at the end of 23, so we can actually put a finer point on that. But I mean, also just the tails assay assumptions from enrichment. We can get into that more if you want, but bringing the thesis to the present, it's very, very clear that there's a significant supply shortfall this year and going out for multiple years into the future unless we have a sufficient supply response from development projects, because restarts of care and maintenance mines like MacArthur River, like Paladin's Langer-Heinrich, like some of the ISR stuff in the United States, Boss's Honeymoon, etc. Restart all of those, we're still at a deficit. So we need new development projects, and we need them as fast as possible in order to balance the market. Nothing happens quickly in this industry. So we're actually looking probably at 4 to 5, maybe 6 years, possibly even longer, before we have a supply response to balance this market, in a market that's extremely, extremely thin, where we're seeing 100,000 pounds or 200,000 pounds traded in the spot market, in some cases meaning a multiple dollar move to the upside. So all of that is kind of like a snapshot of the supply and demand situation currently. But then we also have this nuclear renaissance sort of theme that's in the background that we didn't have when this was a contrarian bet. So even 5 years ago, looking at this sector and recognizing, okay, this is a cool commodity investment, and nuclear looks to be growing in the future, maybe 1 or 2% compound annual growth rate, which is something. Definitely nothing to shake a stick at. And then turning back to today and seeing 24 countries sign a pledge to triple nuclear energy by 2050 globally. And on the back of that, there was news out today that Poland officially is saying they want to build, I think it was 30 GE Hitachi BWRX-300s at 6 different sites.
I've missed that. I haven't even seen that yet.
I think it was 24.
That's very fresh.
Yeah, that's in addition to deals they've made with Westinghouse to build multiple large AP1000s. I mean, I could go on and on, but it's pretty clear to say that there's only a couple of countries that are actually turning away from nuclear. One is Germany and the other is Taiwan. Even countries that recently shut down perfectly good reactors like Sweden and Belgium are actually looking at building new nuclear for Sweden, and Belgium is just about to restart, life extend their last 2 reactors. So Engie, which operates those reactors, probably going to be a buyer in the market in the next 6 months. That should be interesting. But yeah, it's a full-on re-embracing of nuclear, and you have this backdrop of a very, very positive growth outlook for nuclear energy. And that's underpinning this more acute supply shortfall situation. That's really what's going to be moving the price in the next few years. But underpinning all of this is probably a 3 to 4% compound annual growth rate, realistically, now looking at 62 reactors under construction globally, and the number of countries that are looking to build new nuclear and then life extend their existing fleet. It's a pretty brilliant setup.
Absolutely. Now my dog is literally howling at all of these facts. You've just given me like 1,000 different tangents that I could go down and explore. But what I'm thinking is, okay, but despite everything that you've said so far, you and I were talking about this years ago, before we saw a move in the price of the commodity in and of itself. It went as low as $18 per pound, and now it's sitting at whatever censored price. What was it that finally kind of broke the camel's back, in your opinion, of the difference between, like the fundamental thesis looking better and better and better to the price finally catching up? Was it a matter of just the spot price drying up? Was it a matter of the financial, vehicles coming into it? Was it a little bit of everything? How does the secondary market or the secondary supply play a part in this? Or is it more about, inventory just coming to a point where they opened up the cupboards and were like, we're too low, we're going to have to go to market?
I would say it's a confluence of a lot of factors. It would be easy to just give you one catalyst, but I don't think it really came down to one thing. In the early days of this investment, 5-6 years ago, everybody knew that eventually we'd see another contracting cycle, that utilities operate in these cycles where they go through these cycles of restocking and building up inventories and then destocking and drawing down inventories. And it does this, and it has done this over the history of this industry. So the last contracting cycle was the last bull market, essentially, 04 to about 2012. There's 1 year there was less than replacement rate. I think it was 2011 or 2010, if I recall correctly. But that period of time was basically utilities entering into long-term contracts in volume significantly greater than the annual burn rate of the global reactor fleet, right? So that was a restocking phase, and it happened to coincide with a very large increase in the uranium price. That at that point went from below $10 up to $134, I think it was at the peak in 07. So following Fukushima Daiichi accident and Japan shutting off their reactors, Germany starting to shut down their reactors, you had a big demand shock, and you had Kazakhstan ramping production during the same period of time. And they were doing so because they were 100% state-owned, largely influenced by Russia. You can get conspiratorial or not, I don't really care, it doesn't really matter, but you can just see what they did, which was flood the market with cheap uranium for 5 years following Fukushima. The Kazakh tenge was depreciating rapidly, so they were producing in costs paid in tenge and selling in dollars. And they did this hand over fist with massively increasing production until they peaked in 2016, which happened to coincide with the bottom of the commodity. Wink, wink, hint, hint. So that we had such a large amount of excess inventory from that period of time. Demand destruction, supply increase, those two things killed 95% of the companies in the space. All the explorers and the early stage developers from 07, 08, 09, they all disappeared. And we ended up with 40 companies or something like that by the time the commodity bottomed. You have to figure that there was a certain amount of excess supply for that decade, right? So I would estimate between 150 and 200 million pounds of excess uranium that didn't go to China. There was and China bought a lot of uranium in the previous decade, which is why they have such a large inventory right now. Probably 500 or 600 million pounds. It's a lot of U308 equivalent. Not all of it's U308. They are establishing their own conversion and enrichment, but they don't have a lot of in-ground uranium, as you know. So all of that above ground mobile inventory, then you have to start to crunch some numbers. Okay, Cameco, putting MacArthur into care and maintenance 2018, that was essentially a 36-pound swing because they were not only not producing, they were actually buying. And that, they say that they had 100 million pound effect on the market with 4 years of MacArthur River and care and maintenance. That was very expensive for them and very painful for the company. And all of these companies that ended up shutting down or putting in care and maintenance, it's a lot of expense. So you have to consider that into what it takes to restart these things. But that had a big effect. You had some secondary demand from Uranium Participation Corporation, Yellow Cake. It wasn't huge, but it was there. I'm getting up to Sprott, but even prior to Sprott, we had COVID. We had a little bit of shutdowns, a little bit of declining wellfield development in Kazakhstan. That had a small effect in 2020. The carry trades is an important concept to understand, which is when the commodity was very low priced and not a whole lot of producers were actually producing at a profit. Primarily that was Kazakhstan. You had still this above ground mobile inventory that was a decent amount of that, and traders that would enter into these carry trades with utilities. So utility, rather than going to Cameco and saying, hey guys, let's sign a contract at prices that you need so you can bring that mine back online. Like 0 utilities did that. Why? Because they could go to a trader and pay $15 a pound cheaper, and the trader would then buy this mobile inventory from the spot market, and they would commit to delivering that into a contract with the utility. That happened a lot in the late 2010s. That went a long ways towards consuming a lot of this inventory. So it actually was, in hindsight, a relatively good thing for excess inventory consumption. It wasn't a good thing for the producers. The producers were hurting and wanted the industry to step up to the plate, open their wallets, and do them a solid by contracting at higher prices so that they could actually bring their mines online. Well, nobody did that. They didn't have to do that. There was cheaper uranium to be had, and 0 fuel buyers went to their manager and said, I know we've got this budget. I know I can go and buy from the Russians or buy from the Kazakhs or buy from whomever at $27 a pound. But, I'm talking to somebody over here at Cameco and they say they need 42. So what do you say? That didn't happen. So the producers were in a lot of pain for a lot of years. And during this period of time, a lot of that inventory was consumed in these carry trades. Some of it was consumed with excess, with secondary demand from the financials and from producers like Cameco, who was buying material, still is buying material. And then you come to 2021 with Sprott. Sprott takes over UPC. They instigate an at-the-market financing, an ATM. Their initial ATM was quite large. I think it was 500 million, which they re-upped a couple of times. It's substantially smaller now, but we've got much higher priced uranium, so the capital effect on the market is definitely lower. With all of that said, they really did a lot of the heavy lifting in cleaning up whatever was left in just this extra above ground inventory and cake in the can. So they purchased 42 million pounds of uranium, and gosh, most of that was purchased in less than 12 months. That was insane. And so not only did they consume a lot of this inventory that was just sitting in a can, but they also pulled material forward from the midterm. And they did so in what the guys from Sega call the reverse carry trade. They've actually written a brilliant blog post on this maybe 18 months ago. You should check it out. Or your listeners should check it out. You've probably already seen it. But this reverse carry trade essentially was, you had a brief extreme backwardation in the market where you had the spot price jump far above the midterm price, and there still was sufficient capacity in the midterm to fulfill this reverse carry trade. So what happened was carry traders that had purchased inventory from the spot market were holding it on their books that was promised for delivery to a utility going out next year, 2 years from now, 3 years from now. They were sitting on this material, and here's Sprott buying uranium hand over fist, driven by the capital markets at $15 north of the current midterm price. Well, they sold pounds to Sprott, and then they went and they covered their midterm by engaging in a midterm contract with the Uzbeks or the Kazakhs, whoever it might be, right? Then they get fulfilled on that contract and they deliver to the utility in the previous contract they had signed with the utility.
Free
so
money.
they kind of, yeah. So it was a quick buck that traders could make in this reverse carry trade, and they did it. And estimates are anywhere from, okay, so Sprott purchased 42 million pounds. I personally think that there was maybe somewhere between 10 and 20 million pounds that got pulled out of the midterm in this reverse carry trade, in addition to some above ground inventory that Sprott was able to buy in that spate of buying. So that did a substantial amount of tightening on the midterm curve, because you had producers having to fulfill these midterm contracts being engaged by these traders that were selling to Sprott. So that tightened up Cameco and Kazatomprom and maybe a couple of others to Orano, probably a little bit in the midterm. Then we get to the present, and we have a situation where the price trajectory is so clearly bullish and so clearly going up that the entire industry knows it. This is on the heels of Sprott's massive buying and the incredible inventory cleanup that did. I think Sprott's done the heavy lifting. I honestly think a Thesis going forward is 0% dependent on them buying another single pound. But they will. So it's there, and secondary demand is there. Another piece that's tightening the current spot price and the midterm is the lack of underfeeding in the West. So underfeeding was a big source of secondary supply in the previous decade, probably about 26 million pounds per year. Maybe 3/5 of that probably comes from Russia, but still 40% of that coming from Urenco and Orano enrichment in the West, that's gone. So because of the tight enrichment market and the bifurcation that's happened since the invasion of Ukraine, which is kind of the last, I would say, catalyst that's accelerated what would have happened and made things even more difficult for Western utilities, which are 70% of global demand is utilities in the quote unquote West. So you have a very, very thin spot market. You have a very tight midterm curve because the producers have essentially almost sold out their capacity going out for the next 3 to 4 years. And then we're talking about Cameco, Orano, Uranium One, Kazatomprom, and to some extent some of the other JVs with Kazatomprom. But those are the big players. Even BHP supposedly has been has been pressured into engaging into contracts when for the most part they sell into the spot market, or sometimes some short-term spot reference contracts. But supposedly that's what we're hearing. I can't substantiate that, but hearing that BHP has kind of been getting the screws turned to them by utilities saying, hey guys, come on, let's sign something here. We need some pounds. The invasion of Ukraine by Russia, what that did was it put a big concern about supply to utilities globally, because Russia is the biggest player in conversion and enrichment. Those are the last two very crucial pieces of the fuel cycle, the closest elements to fabricated fuel, and utilities actually getting their material to operate their plant. So when the biggest player in conversion and enrichment is compromised, let's say, or at the very least, there's been a lot of self-sanctioning by utilities in the West to not do new business with Russia. They still have been receiving material from previous legacy contracts. So despite all of the big talk, US utilities, Canadian utilities, European utilities, for the most part, still receiving Russian material, but not really voluntarily engaging in new business with Russia. So we had this massive clamoring for Western conversion and enrichment last year following that invasion. I realize I'm going on and on. I'm trying to pull all of these catalysts into one picture.
This is, I don't have a bowl of popcorn here because it would stop me from talking. But this is like for uranium investors and people who want to get into this, like this is beautiful. So please go on.
Yeah, great. Okay, so I would say, your original question asked about the straw that broke the camel's back, and I would say there hasn't really been one straw, but if I had to say what that straw was, it was probably the war in Ukraine and the response of the industry to it, because conversion and enrichment are so limited in the West. So what happened is you had Western utilities clamoring for conversion and enrichment last year, and we saw the prices double for both of those services. And the products, UF6 and EUP, went up huge as well. So in the last 18 to almost 24 months, we've seen 100 to 200% increase in price across the fuel cycle, except for uranium. So the theory, not really a theory, it happens. If you look at the fuel cycle, the stages: uranium mining, conversion into UF6, enrichment into EUP, fabricated into fuel, skipping a couple little processes, but that's the main thing, is utilities will always, especially in a period of concern about supply and security of supply concerns, will always go towards the end of the fuel cycle first. So if you can buy EUP at the level of enrichment that you need for your plant, you're gonna do it. You're just gonna straight up buy that enriched uranium. Now, because there's different levels of enrichment for different plants, it's less likely that the EUP at your enrichment level is sitting there available to you. It does happen, but not that often. So if you can't buy EUP, you buy enrichment and you feed UF6 into it. So you buy that enrichment contract, you sign a contract with Urenco or Orano in the West, and then that contract is for a certain period of time. Let's say it's 2026. That means between now and 2026, you have to secure UF6. Well, conversion is so tight and so limited in the West, fully booked out almost to the end of the decade, between ConverDyn, Port Hope, and Commurex in France. Those are the main three big Western converters, pretty much fully booked in terms of their overall capacity. There's talk about Springfields in the UK being restarted. ConverDyn can expand, but there's no promising of that happening. For now, very, very tight market. Not a lot of UF6. In fact, I would argue there's basically zero UF6 just sitting there in a can for somebody to buy right now. So if you are a utility and you purchased enrichment, you can't find any UF6, so you purchase conversion. We know that that's happened because they are fully booked. So you own enrichment, you own conversion, now you have to buy uranium. And there's no use buying uranium and not having your conversion and enrichment booked, because that yellow cake is useless to you if you can't convert it and enrich it. It's literally useless, other than you can sell it to somebody else, but you're not really interested in trading if you're a utility. In fact, I know of one utility fuel buyer who actively trades uranium, out of all of them that do not. They secure material for their operations, period. And they do so when they need to. That's another important element. They don't try to time the market. They don't buy when it's cheap and try to get an award from their management. They don't want to risk timing the market because that hasn't worked out for them necessarily all that well in the past. Now we're clearly in the price rising environment, but utilities buy when they need to buy. So coming back to conversion enrichment, we knew last year that the big moves in conversion enrichment would trickle down to uranium, and that's absolutely what's happening. We've seen spot uranium rise by almost 70% this year. It went from, I think it closed in December 31st last year at $46 or $48 a pound. Now we're sitting here at 81.55 at the time we're recording this. I don't know when you're going to publish it, but that's where we're at right now. And the price is going to keep going higher. It's very clear what is going to stop this price trend, and that's going to be supply. Now, besides actual increased mined supply, the only other option is inventories being sold into the market to actually stem the price rise. There's not a lot of entities with sufficient inventory to accomplish that, probably besides China. So that's a big question right now. Will China sell inventories into this market to stem this price rise? Can they? Yes. Will they? That's an argument. So far, the price has gone from 18 to 81.50, and the Chinese have turned from sellers to buyers. In fact, this year, they've turned from sellers to buyers. They have been entering into massive contracts with Kazatomprom, 2 contracts that were so large that they had to have special shareholder votes to approve these contracts. And they actually have been buyers in the spot market this year as well. So all of those things that I just mentioned are bringing us up to this point today. And there's sort of this kind of come to Jesus moment for the utilities right now that have sat on the fence last year, waiting to see if this situation in Ukraine, especially with Russia, would sort of resolve itself and they could go back to business as usual. And there's been a lot of utilities that were fence setters last year that now have RFPs in the market or off-market conversations for entering into term contracts. So we know roughly how much the utilities have to buy for their needs. We don't know how much they're going to buy to restock inventories that are historically low, not panic levels. I don't really like the panic narrative, by the way. Will we see that? Maybe, but that's not something I'm betting on. Inventories are historically low, commercial inventories, about levels we saw back in 04-05. We know what happened after that. So there's restocking inventory pressure that's potential. There's financial buying that's potential. Neither of these things you can model out, but they're both there. But basically uncovered needs based on structural annual burn up for reactor operations. We know how much needs to be purchased. And then you can also look at what mines are going to be able to produce in this window. As far as I can tell, we're sitting like in the early stages of a 3, 4, 5 year supply black hole with a lot of utility demand coming. And I don't know what slows this down. So I'm pretty excited to see where this goes in the next few years.
Speaking of which, with that in mind, knowing that supply is just, the real bottleneck here, and it looks as if demand is not going to go anywhere but up. Taking into consideration that mobile inventory is different to just inventory, and that not everybody may be able to or willing to sell inventory into the market, to make a buck. What do you think this looks like? Do you think that we just slowly climb in price until we're sitting here talking about $300 per pound? Or do you think like we just get a massive spike of, I don't know, speculators coming into the market? Like, what is your thesis regarding what the price of the commodity, let's forget the equities for now, but what do you think the commodity is going to do moving forward, within the next 3 years? I know it's a lot because everything changes so quickly.
It's a difficult question to answer because I think what my answer really is that we're going to see a price that doesn't make sense. A price that makes sense is really what the marginal project needs to be profitable, right? So, and that really was kind of the basis of the long thesis years ago. You had, okay, well, it certainly didn't make sense to have a uranium price that even the Kazakhs were making maybe pennies on the dollar, 18 bucks a pound. All things considered, they were barely profitable at that price, barely, and maybe not. Once they went public, of course, paying a dividend and then looking at their all-in sustaining costs, their cash costs of like, oh, we've got cash costs of $9 a pound. Yeah, but your fully allocated cost here for Kazakhstan is probably 40 bucks, maybe 45. which they're killing at 80, but they don't sell at that price because they enter into long-term contracts primarily. So really what we were looking at before is, okay, the price is $18 a pound. Where does it need to go? And that was the original question to be long this sector. Where does the price need to go? And then you can look at the marginal projects that would have to come online to balance the perceived supply deficit at that point. So in 2017, looking out and saying, okay, if this market balances by 2022, what projects have to come online? What price do they need? So that was kind of the core thesis. And at that point, you were looking at maybe Global Atomics, DASA, restart of MacArthur, the restart of Langer Heinrich, and the demand picture was certainly different back then. So those projects alone could have done it. I think maybe a couple of greenfield projects, but you were probably still looking at, 50, 60, maybe in the mid 60s of a incentive price for the marginal projects to balance the market. That's 5 years ago, 6 years ago. Now, this is something that I was speaking with a fuel buyer a few weeks ago, and he brought this up to me, and it really got me thinking. He's like, there's no reason the price was 70 something at the time. It's like, there's no reason the price is here. There's no reason it's not 50. There's no reason it's not 100. It's just what sellers are willing to sell it at. That's what the price is right now. And I guess that's true about anything, right? You pay what you're willing to pay and what the seller is willing to sell it for. So an example recently is the Koreans came into the market with an RFP, and they actually dictated the floors and ceilings in the RFP. So most of the time an RFP is like, hey, we need this many pounds delivered starting in this year, going for 5 years. That's the request for proposal. And then you get proposals and you choose who to award that contract to, which supplier to award that contract. Well, the Koreans said, okay, we need this amount of pounds delivered for these years. And we're willing to pay a floor of this and a ceiling of this. And the market was just like, it didn't get filled. And then that's kind of where we're at now. So you have this idea of incentive price, honestly, at this point, I think is practically irrelevant, because we're pretty much at a price where most projects, even greenfield projects, and I bring up Namibia because they're the large projects that can theoretically balance this market. We're talking, 4, 5, 6 million pounds per year, and there's 3 or 4 of these big projects with 100 to 200 million pounds in resources, right? But hundreds of $1 million of Capex and multiple years of development. So we're already at those incentive prices, or at least close to it. Maybe some of these Namibian projects want 90 to 100 now with the inflation we've seen in the last 3 or 4 years. But that doesn't mean that supply comes into the market anytime soon. So we could be at $100 tomorrow. It doesn't mean that supply is going to be here any sooner than if we sit here at $81 for the next 2 years. It's not going to accelerate the pounds coming into the market. Supply is just so slow to respond. So the projects that are profitable are working towards producing right now. We've got some US ISR stuff, Global Atomics, DASA doing what they can amidst a difficult political situation in Niger. Some of the Namibian projects are working on updating their feasibility studies and working towards final investment decisions next year or 2025. So they're kind of sniffing around a little bit, but pretty much everything else, the Kazakhs are talking about ramping. So far, there hasn't been sufficient Capex to even keep up with production, let alone ramp their production by 35, 40% in the next 18 months.
It would be nice if they would just hit the first numbers that they promised, sure, and then expand. Maybe they would consider that.
Yeah, we haven't seen the Capex increase yet. So we think their 2024 targets are not going to be hit. And we think they're going to come into the market in January, February and tell the market we're going to miss, which should be an interesting little catalyst maybe. So the incentive price is sort of irrelevant because we're sort of close to being there, yet the pounds are not going to be there. And based on looking at the fact that the price is what it is, because that's just where sellers are willing to sell, and amidst the amount of buying, which the buying in the spot market has been declining in volume, and that the price has been going up and up and up. So that's really interesting. That tells you that it's not a demand-driven spot market right now. It's a supply-driven spot market, because you saw the big spikes in the last 2 years that came from Sprott. That was a demand-driven spike. Sprott came in, they ramped it up, they bought 10, 15 million pounds over the course of a month or two, and then they stopped because the capital stopped flowing, and the price came back down. High or low, but it still spiked and came back down. Now this is a supply driven move, and it's going to remain a supply driven move. So this is a very long way of saying, I think we're going to encounter a situation within the next 24 to 36 months, and possibly sooner, where we're actually going to have utilities in bidding wars for small amount of remaining available pounds. So that can do crazy things to the price, and that has nothing to do at all with capital markets. And we've actually had, I mean, just this past week, UXC, actually it was the week before, warning their readership essentially that we have an insanely thin spot market, and the capital driven vehicles are all set up, and if they smell blood in the water, their words, then we're going to see a crazy price spike. I don't really want to see a price spike necessarily, but that's out of my control. So everything is there ripe for the picking, whether or not we see those capital flows or not. Sufficient to move the price substantially, and see Sprott or Zuri or PFYN or even Yellowcake in the market competing with utilities who are competing with each other. We could get some animal spirits, and we could see prices that don't make any sense whatsoever for the industry. So last thing I'll say about price, I don't think enough people are recognizing the effects of inflation. The price $81.50 here a pound is to $55 in 2006. So it's, historically speaking, we are not seeing overpriced uranium, and utilities will pay what they have to pay to get that material. And we could see the price of uranium spike crazy high and still see conversion and enrichment prices in this ballpark here. That could happen. You have to remember, okay, the overall cost of uranium conversion, enrichment, deconversion, fuel fabrication, all of that together is 13 to 15% of a nuclear power plant's operation cost. Uranium itself is more like 3 to 5%. So that can spike like crazy. I've heard through a trader contact in the industry that a fuel buyer straight up told him straight to his face, we'll pay $1,000 a pound if we have to. So of course you can't bet on that, because there's no reason for it to go there unless you are literally having a situation where a utility needs this material for their operations and they're fighting with others who need the same. Then those prices are going to not make sense and go crazy to the upside. The big wild card is China's inventory. But so far, the evidence has been exactly opposite of what people are concerned about, which is, and the Chinese are going to stop buying there and start selling. Well, they're buying like crazy. Plus their build out. I mean, if they even get close to their goal of 150 gigawatts by 2035, 150 gigawatts. It. Yeah, 150 gigawatts is, let's see, do some quick math. What is that, 75 million pounds a year? So you think that they're going to be comfortable with sitting on 6 years of inventory and zero domestic production? And not zero, a couple million pounds a year. Mm-hmm. They have no domestic production of uranium. So they can build out as much conversion and enrichment as they want. They're going to need that Yellowcake. And that's why they're clamoring for these contracts with Kazatomprom. They're going to buy up everything they can, because that's A, it's the cheapest production. B, they share a border and they're building this big ass warehouse right on the border to store uranium for their own use. So I don't expect the Chinese to sell. And that's unless and until we have a situation where they can replace the sold pounds easily in sufficient volume and at lower prices than the market. So far, that's not the case. So we'll have to look for that evidence.
I would tend to agree. And the Chinese don't do anything in even months to years. They do everything from years to decades, right? That's the whole thinking. The Chinese way is to plan things out 20, 30, 50 years in advance and then just go out and execute it like crazy. How does that translate into, or does it translate into picking equities?
Well, I think that in a classic sort of investment style, trying to find equities that have a lower valuation than what the market is pricing in, or than what they deserve, let's say, if they're trading at a discount to their value, their true NAV, then that's obviously a bargain. Looking for companies that can actually turn into real companies and produce something which is to say actually mine something out of the ground and produce cash flow. Those are the companies that we tend to focus on. Of course, you can make a killing if you get a drill play right. If you can invest in an explorer before they make a discovery or in the early stages of a discovery. Just like Next Gen or ISO Energy, it looks like there's a few right now. They're making some decent hits that could be big winners. You can make a killing on that front. So far, it's been kind of a classic mining stock move in the sector where we've seen the large cap producing stocks outperform. At least that's over the last 12 to 18 months, that's been the case. If you go back to the COVID lows, there's still some small and mid cap developers and explorers that have outperformed, the Camecos and the Next Gens of the world on a total return basis from those lows. But I don't think that's really an appropriate way to look at it. I think that, and we've seen this over and over with gold and silver stocks in previous runs, where you see the big caps move first, and then the second half of the investment is when the small caps really shine and tend to drastically outperform the large caps. I think we're close to a pivot in the market where we're going to see the smaller and mid caps start to outperform the large caps. Not quite there yet, but I think it happens still. Choosing equities, we've got our own formula for doing that. We obviously look at management first. That's crucial. We look at share structure, which is very, very important. Not only just outstanding share count, but looking at outstanding options and warrants and recognizing what sort of effect that might have on the stock price going forward. Looking at historical levels of dilution and expected levels of dilution. How much cash do you have? How much do you need on an ongoing basis? When will you be raising again? Those are important questions for anybody that's first buying a stock.
Historical levels of dilution sounds like music to my ears. It's like, go back and look at the chart at the very least, and do realize that the market cap back then is not the same market cap now, just for starters.
Yes, absolutely. No, the denominator has changed, and it's changed even in the last 2 years. So a lot of these stocks on a market cap basis are trading well above the 2021 highs. At a share price basis, most of them are not, probably because the denominator has changed substantially, because the money is flowing into the ETFs constantly and continues to right now. So there's some retail selling pressure against that, but management, share structure, jurisdiction is important. We don't like to gamble on jurisdiction. I understand if a good deposit in a jurisdiction where it's currently illegal changes and shifts to legal, that's a massive win if you're holding that stock, but that's just not the type of gamble I like to make. And then lastly, I think one of my favorite elements of seeking out an investment is trying to get my head around some kind of X factor for that stock. So you have to find a good balance in promotion. I think an over promotion is sort of a turnoff, and if a company doesn't promote at all, then nobody even knows they exist. And there's a problem with multiple stocks in this space, where good conservative management, that you have to respect the fact that they've operated conservatively, but nobody talks about them ever. There's multiple companies like that, and it's very frustrating. But trying to see, okay, this company, and usually this is a management-based decision, because you have to recognize what the management of this company has done in the past, and will they do something similar in the future. So seeing maybe there's some stuff that's just not on their presentation, and they're not going to tell you to your face, but they probably will do over the course of this bull market. And I'm talking about like M&A activity, getting projects towards production that the market's not paying attention to. There's a few operators in the space that are movers and shakers, and I think those are the type of investments I really like, because that can mean unexpected catalysts, and the market likes catalysts. They want to see that a company is remaining relevant. They're out there, they're doing something. It's much more exciting than a company that discovered something 25 years ago and they're just waiting for the price, and in the meantime they're diluting every 3 or 4 years, and they're just sitting there on their hands. And while that can be a conservative move, in some ways respectable, it's not very exciting from a stock speculator standpoint. So all of those things together, but I would say the number one thing for us is we like companies that are real companies more than anything, not lifestyle companies. They're gonna produce cake in a can. They're gonna produce some cash.
Cool stuff. Justin, this has been like the funnest conversation I've had all month.
Awesome.
Thank you so much for coming on. And let us know how to, get to know more of your content and sign up to your newsletter if somebody's interested into, knowing more about the stuff that you do and the kind of offers that you have a bit available. How can they do that?
Sure. Well, our website's uraniuminsider.com. It's right above my head. We are 100% focused on uranium. So we don't dabble in any other sectors currently. Our focus is this market. And most of our focus is on the physical market. So more than anything, understanding what is going on in the physical uranium market is absolutely paramount in our opinion. You have to know what's happening. So maintaining connections with industry contacts is super important to us. And then we take that information, we distill it down into actionable information for our members. And that's important for us. Our historical track record is relatively solid. We've returned, let's see, I think it's right around 400% since inception in 2019 against the benchmark, which is maybe 150%. That's just off the top of my head. I haven't calculated in the last few days. So we've done a pretty good job of stock picking overall, especially since inception. And we do members only webinars once a month. We actually have 2 this month because we're doing a special webinar next week with some technicians that should be fun. But we bring on industry experts. Dustin Garrow, Per Jander from WMC. We've had Grant Isaac from Cameco, Art Hyde from Segra, Mike and Tim from Station Cove, and a bunch of other individual company reps from the companies that we follow and recommend. And that's always a great event. It's 2 hours. We get really deep into the weeds, take a lot of questions, do a Q&A with our membership. That's always a fun event. And then actionable bulletins that we send out as needed based on individual company or market moving news. And then on top of all of that, we do a daily market update. And that's sometimes video, sometimes it's just a conglomeration of information, but that's every single day. So we make sure that we keep our membership informed as much as possible about this market because it is very volatile. It shakes most people out, as you know. The sentiment can swing extremely wildly and in a very, very short span of time. It's actually quite entertaining. But yeah, we try to keep on top of things so our members don't get shaken out. Primarily, that's number one for us is understanding what's going in the physical market, making sure that our membership understands as well. And yeah, it's been a great run. I've got a good team behind me. My partner is an ex-hedge fund guy with like 40 years in the metals and mining space. And then we've got a small team helping with operations in the background. And we think that this market has legs. Like I mentioned in our chat, I don't know where the supply response is going to come from. And until it does, until we have, Arrow and Phoenix and Dasa and Kazakhs increase and Uzbeks increasing and maybe Mongolia with the French and US ISR producing 5 million pounds a year and all of that, then we balance the market. And it's going to take a while. So it's going to be fun between now and then.
Teams. I don't know where you get the people to go and work in all those different projects because it seems like they're not around anymore, right?
Yeah, we're already hearing kind of some whispers about the US companies clamoring over drillers. There's just only so many drill rigs out there, and there's a fight over skilled labor. And this is not in the US. This was the theme at NEI last in October when I was there. And this was nuclear utilities. This is the mining companies and everyone in between. They were all saying there's the skilled labor is getting close to retirement age and it's not being replaced in sufficient numbers. And that's a problem.
Yeah, it's the whole cycle. And if you're young and you're watching this and you're interested in anything from nuclear engineering to drilling holes in the ground to pulling uranium out of the ground, then, hint, hint, nudge, nudge. This might be an industry for you, and you're probably going to get lots of different people bidding for your skills if you can build them quickly enough. Thank you so much, Justin. I hope to speak to you soon with probably more positive news about this market that never fails to surprise me. Thank you so much for coming.
My pleasure. Always good to talk to you.
Cheers.